Before John Bogle changed investing, the financial world often presented wealth management as a contest of superior judgment. Investors were encouraged to search for talented professionals, follow market forecasts, and pay for the possibility of beating the average. Bogle saw a different reality. Most people did not need a more complicated strategy. They needed broad ownership, disciplined behavior, and a structure that allowed more of their returns to remain theirs. John Bogle was a persistent mutual fund executive who challenged the assumptions of his industry. He recognized that active management depended on professionals selecting securities that would outperform the market, while investors paid fees for that effort. The difficulty was not finding an occasional winner. The difficulty was doing it consistently, after costs, across changing markets and over long periods. In 1976, Bogle launched the first index fund designed for individual investors. Its purpose was straightforward. Instead of trying to identify a small group of winning companies, the fund tracked the S&P 500. That design represented more than a new financial product. It was a direct challenge to the idea that successful investing had to be expensive, highly managed, and constantly adjusted. The concept became known as passive investing. Passive does not mean careless, inactive, or uninformed. It means accepting the market's broad performance instead of repeatedly attempting to outguess it. An index fund follows a defined collection of assets according to a stated method. The investor is not paying a manager to make continuous predictions. The investor is buying participation in a wider economic system. That distinction matters because every investment strategy has friction. Fees reduce the amount of money that remains invested. Trading can create additional costs and tax consequences. Frequent decisions create opportunities for fear, excitement, and overconfidence to interfere with a long-term plan. Bogle's contribution was to make those frictions visible and to build Vanguard around the principle that low-cost ownership could serve ordinary investors. Vanguard became the institutional expression of that principle. Rather than treating investors merely as customers purchasing a product, the organization was structured around the interests of the funds and their shareholders. That model helped reinforce a powerful message. Investing could be designed to reward patience instead of activity. The goal was not to make every market decision correctly. The goal was to keep a greater share of the market's potential working for the investor. This was a democratizing shift. Before index investing became widely accepted, many people viewed the market as a specialized arena requiring expert selection and constant supervision. Bogle's approach lowered the complexity barrier. An individual did not need a private analyst, an elaborate trading system, or a dramatic prediction about the next winning company. The individual could own a broad index fund, contribute consistently, and allow time and participation to do the heavy work. The transition from active wealth management to passive investing was not a rejection of intelligence. It was a redefinition of where intelligence belongs. Instead of spending all your energy trying to forecast the next market move, you can focus on choosing an appropriate allocation, controlling costs, managing taxes, and maintaining behavior through uncertainty. The sophisticated decision is often made before the market opens. Establish rules, understand risk, and follow the plan. For a household seeking generational wealth, that blueprint begins with a financial foundation. Separate immediate needs from long-term capital. Maintain liquidity for obligations that cannot wait. Then direct appropriate money toward diversified, low-cost index funds that match the time horizon and risk the household can genuinely tolerate. The purpose is not to make a dramatic bet. It is to create a repeatable ownership system that can continue through ordinary market cycles. Consistency is more important than excitement. A contribution made during a difficult period may feel uncomfortable, but a long-term investor should expect markets to rise and fall. The strategy must be judged by its design, not by the emotion of a single week or year. Passive investing works best when the investor understands what is owned, accepts that prices move, and avoids turning temporary uncertainty into permanent damage. This does not mean every person should hold the same portfolio. An individual's obligations, timeline, income, tax position, and tolerance for loss all matter. The lesson from Bogle is not to copy a symbol without thinking. The lesson is to remove unnecessary complexity, use broad diversification where appropriate, keep expenses under control, review the plan deliberately, and distinguish a genuine change in circumstances from a passing change in market mood. The same discipline can guide real estate acquisition. Property can provide utility, income, and a tangible form of ownership, but it also brings financing, maintenance, insurance, taxes, vacancies, and legal responsibilities. The intelligent approach is not to purchase simply because property feels permanent. It is to evaluate cash flow, reserves, debt terms, location, and the role the property plays in the overall balance sheet. Index funds and real estate solve different problems. A broad fund can offer liquid exposure to many businesses, while property may provide control over a specific asset and the possibility of operational improvement. Neither should be treated as a guaranteed path. A durable wealth plan compares the risks honestly. It asks how much concentration the household can withstand, how much liquidity it needs, and whether an acquisition strengthens or weakens the entire financial structure. Strategic entrepreneurial ventures belong in that same framework. A business can create income, intellectual property, and equity, but it can also concentrate risk in one industry, one customer base, or one operator. The entrepreneur should avoid confusing hard work with diversification. Build the venture with clear records, disciplined cash management, written agreements, and a plan for separating personal finances from business obligations. The power of Bogle's thinking is that it provides a stable core around which more specialized opportunities can be organized. Entrepreneurship may produce concentrated upside. Real estate may create a controlled, tangible asset. Index funds can serve as a broad ownership base. The objective is not to make every asset behave the same way. The objective is to prevent one ambitious project from determining the fate of the entire family. Asset protection begins with that separation. Ownership should be organized thoughtfully, with appropriate legal and tax guidance, so personal assets, business activities, and investment properties are not casually mixed. Maintain accurate records, use suitable contracts and insurance, understand the rules governing entities, beneficiaries, and transfers. Asset protection is not a last-minute shield created after a problem appears. It is a system designed before pressure arrives. Generational wealth also depends on communication. An investment account may be valuable, but future beneficiaries need to understand what it is, why it exists, and how it should be managed. Families can document their principals, identify account locations, clarify responsibilities, and establish a process for reviewing major decisions. The purpose is not to control every future choice. It is to transfer judgment along with capital. That is where passive investing becomes more than a portfolio technique. It becomes a behavioral inheritance. A family that learns to value low costs, diversification, patience, and ownership is less vulnerable to fashionable speculation. Children and successors do not need to memorize every market headline. They need to understand the difference between an asset that produces broad participation and a story that merely produces excitement. Bogle's revolution also changed the competitive pressure within the financial industry. When investors could see that a simple index approach was available at low cost, complex products and high fees faced a more direct question: what additional value is being provided? That question remains useful today. Before accepting any investment expense, ask what service it pays for, whether that service is necessary, and whether the expected benefit can be evaluated honestly. A practical review process can remain simple. Examine the purpose of each account. Identify the total cost of ownership. Check whether the portfolio is diversified in a meaningful way. Confirm that the risk matches the time horizon. Review real estate debt and reserves. Review business exposure and insurance. Then make changes because the plan has changed, not merely because the market has become loud. This approach also protects attention, an asset that is often ignored. Constant monitoring can create the illusion of control while encouraging unnecessary action. A deliberate schedule for review allows the investor to remain informed without becoming reactive. The point is not to avoid information. It is to prevent information from becoming a trigger for undisciplined behavior. The historical significance of John Bogle and Vanguard rests in that combination of simplicity and conviction. In 1976, the index fund built around the S&P 500 offered individual investors a way to participate in the market without relying on constant stock selection. Passive investing turned broad ownership into a practical strategy and made low-cost mutual funds central to the conversation about retirement and long-term wealth. The broader lesson is not that active management has no place anywhere. Certain investors may have specialized knowledge, unusual objectives, or a legitimate need for tailored management. The lesson is that complexity should earn its place. A strategy should not be considered sophisticated merely because it is expensive, difficult to explain, or filled with activity. Clarity is a form of risk management. For ambitious individuals, the blueprint is therefore layered. Build a resilient base with disciplined saving and diversified low-cost index funds. Add real estate only when the economics and responsibilities are understood. Pursue entrepreneurial ventures with controlled exposure and professional structure. Protect assets through separation, documentation, insurance, and appropriate legal planning. Then communicate the system so the next generation can preserve its purpose. John Bogle did not promise that markets would be predictable. His revolution came from accepting that they were not. By reducing the need to forecast, lowering unnecessary costs, and expanding access to broad ownership, Vanguard helped ordinary investors participate in long-term wealth creation on more rational terms. The enduring advantage is not a secret prediction. It is a repeatable process that leaves room for patience, protects against avoidable mistakes, and turns investing from a performance contest into an ownership discipline.